Listen carefully, because what I'm about to reveal will change everything you thought you knew about the silver market right now. While everyone else was panicking during that massive sell-off, I told my community exactly where silver would find support. Not $72, not $71, $74 precisely. And guess what happened? Silver bounced from that exact level, rocketed to 79, and it's sitting at 77 as I'm recording this. That wasn't luck. That was reading the tape like a professional, identifying critical patterns, and understanding how institutional players move the market. But here's what matters more than being right about that bounce. We still haven't seen the violent displacement we need. Without that explosive move backed by serious volume, we're not in breakout territory yet. We're watching range-bound action, and that's exactly how you need to treat it. Now pay attention to what happened overnight, because the mainstream media won't tell you this story. The Shanghai Futures Exchange just suspended 2 more account groups. That brings the total to 22 suspensions in just 7 days. 22 account groups on a major global exchange. Let that sink in. This isn't business as usual. This is intervention at the highest level. And while that's happening, the Shanghai premium just exploded to $9 above the international price. $9. It was $7 in my last update. This is John speaking, and if you're learning something valuable here, if you're verifying this data and it's sharpening your edge, drop a comment saying John below. That's how I know who's actually paying attention versus who's just scrolling through content without taking action. And if you're not following me on X yet, you're missing half the intelligence. Real-time updates, data drops before they hit this channel, unfiltered analysis. The link is right in the description. Follow now. Here are your current prices. Western silver spot is at 77. Futures are 77. Shanghai spot is 86. Shanghai futures are sitting at 88. That's a $9 premium, up from $7 in my previous video. Western gold spot is at 4,967. That premium expansion from $6 to $7 to $9 while Western paper markets consolidate is telling you something crucial. Physical demand in the East isn't backing down, despite the manipulation you're witnessing in real time. The Shanghai Futures Exchange didn't just suspend accounts for fun, they suspended them for trading violations during overnight silver futures manipulation on Thursday, coordinated with United States traders. When you see enforcement action ramping up like this, the exchange is sending a message. The games being played crossed lines that even they won't tolerate. This is all documented in SHFE Article 16 enforcement disclosures. It's public, accessible, verifiable. Go check it yourself. COMEX registered silver is now down to approximately 93 million ounces after another 5 million got yanked yesterday, Friday the 13th. The vaults are bleeding out. So ask yourself this question. Is COMEX fighting for its life to stay solvent, or is this just another managed drawdown? Because March open interest is sitting at roughly 60,000 contracts after 6,000 rolled from March to May. That's 295 million ounces of paper claims against 93 million ounces of registered physical, a coverage ratio worse than 3-to-1. Did COMEX offer sweetheart deals to prevent people from standing for delivery? Are desperate shorts buying themselves time? 6,000 contracts rolling forward suggests massive pressure to push delivery obligations into the future. But here's what really matters. It's nowhere near enough. Want to know how many long positions yesterday's price slam actually shook out? Approximately 1,500 contracts. That's it. 6,000 contracts dropped from March open interest. Roughly 3,600 rolled into May, which is actually bullish positioning when you understand what that means. You still have 295 million ounce equivalent of silver in open interest on March contracts versus 93 million registered at COMEX. Check the CME open interest reports yourself. They're updated daily. The data is right there. Here's the technical update for those of you actively trading. In my last video, I said if 74 holds, we could see an inverse head and shoulders pattern developing. Silver crashed to exactly $74, bounced hard, rallied to 79, and it's currently at 77. That 74 level acted as support precisely where the technical structure suggested it would. But, and this is absolutely critical, we haven't seen violent displacement yet. We need a proper base formation first, volume confirmation, and a clear break of resistance with follow-through before we validate the bullish thesis. You don't catch falling knives in this game. You wait for confluences to stack up in your favor. On top of everything happening in silver, we have a major macroeconomic catalyst dropping today. United States CPI data comes out this morning, and it will have direct impact on silver prices. Inflation prints shape expectations for Federal Reserve policy, which drives the dollar, and by extension, precious metals. A hotter number could strengthen the dollar and pressure silver downward. A cooler print could reignite rate cut expectations and fuel a massive rally. So what do? We wait. We watch how price reacts around the CPI release. We let the market show its hand before committing capital. That's not being indecisive. That's being disciplined. That's how professionals operate. The 150 exponential moving average on the hourly chart is now at $81. That's your resistance overhead. As long as price trades below 81, the technical structure shows continued vulnerability to the downside. If price reclaims 81 with conviction and volume, that shifts the entire technical setup. Until then, caution is warranted if you're trading paper. This is tape reading education. I'm showing you the key levels that matter for risk management, not giving you lottery tickets. Now here's what that massive shakeout actually accomplished. Almost nothing. The banks managed to extract only about 2 million ounces of silver from SLV holders during the crash. That's confirmed by the roughly 2 million share drop in SLV's count. The wash trading on SLV during the last session was off the charts, with overall only approximately 2 million shares net sold. That's a pathetic result for such an aggressive attempted shakeout. When you orchestrate massive price suppression and only manage to extract 2 million ounces from the largest silver ETF on the planet, that tells you holders aren't panic selling. Check SLV shares' outstanding data yourself. It's reported daily, publicly accessible, verifiable through custodian disclosures. Isn't it fascinating how silver price can fall 11% without anyone actually selling anything? The lack of volume tells you everything you need to know. This is exactly why people are standing for physical delivery at record rates. When price moves violently, but volume is razor thin, that's not organic market action. That's algorithmic spoofing, coordinated suppression, paper manipulation without real physical metal-changing hands. Liquidity is so thin right now that it's becoming very difficult for banks to hide their trail when they execute these operations. We've seen repeated instances of everything sell-offs over the last 3 weeks. Equities, commodities, risk assets, all getting hit together with falling yields. That's not healthy rotation. That's liquidity stress creeping into the system. Broader market internals are weakening. This may be the early phase, not the end. When you see coordinated liquidations across uncorrelated asset classes simultaneously, that signals underlying stress in the financial system itself. Margin calls, forced deleveraging, liquidity constraints hitting multiple markets at once. Here's the data point that changes everything about March delivery pressure. The Shanghai Futures Exchange closes for Chinese holidays on Sunday and reopens on the 24th. They're closing with 353 tons of physical silver in their vaults, equivalent to approximately 11 million ounces. Total open interest at SHFE for February 26th and March 26th futures is approximately 360 tons of physical silver. That's essentially 1-to-1 coverage with zero buffer. From where I'm sitting, COMEX breaks first. When Shanghai barely has enough physical to cover its own paper claims, that removes the arbitrage safety valve that previously could absorb COMEX delivery pressure. Shanghai Metals Exchange closes Sunday, February 15th through Monday, February 23rd. 8 days. I've been telling you this for 3 videos straight. Expect heavy manipulation in fraudulent paper markets during this window. The banks are executing their playbook exactly as I outlined. They're using this calendar-based period when Eastern physical buyers disappear to maximize downside pressure without real absorption. The pattern is documented historically. Check price action during past Shanghai closures if you don't believe this is standard operating procedure. Now, let me connect the geopolitical chess game that mainstream media is deliberately misrepresenting. Bloomberg leaked a supposed Kremlin memo claiming Russia is rushing back to the United States dollar under Trump. The reality is completely different. This internal document lists 7 possible areas of cooperation with the United States, but only after Ukraine peace and major sanctions relief. Using dollars in bilateral trade is one conditional suggestion to stabilize reserves and reduce volatility. This is brainstorming inside the Kremlin, not official policy, not surrender. Russia's trade with China and India is now 90 to 95% in rubles, yuan, or local currencies since 2022 sanctions hit. BRICS internal trade reached 60 to 67% without dollars. That's a massive shield against Western financial pressure. Any dollar use with the United States would be narrow, temporary, fully conditional on compensation for frozen assets. Russia learned the hard way about over-reliance on the weaponized dollar system. Repeating that mistake wholesale makes zero sense when they've successfully built alternative payment infrastructure over 3 years. Here's what the Kremlin made crystal clear. If the United States lifts restrictions on dollar use, they will have to compete with alternative currencies increasingly being used in the world for settlements. The yuan will continue growing as an international currency. Same applies to the ruble and other currencies. The days of a single world reserve currency are over. There is no need to have one, and no nation with a functioning brain would aspire to being the world reserve currency going forward. China certainly doesn't want that burden. Connect this to why gold keeps rising despite these propaganda narratives. China's treasury holdings are at their lowest level since 2008. China is urging banks to cut exposure as well. India reduced holdings too. Meanwhile, both countries are accumulating gold. Less paper, more metal. When the largest foreign holders of United States debt systematically reduce dollar exposure while accumulating physical gold, that's not temporary repositioning. That's a structural shift in how global settlement works when trust in the dollar system erodes. The rally in gold began in 2022, exactly when the United States weaponized the dollar against Russia. Central banks started moving from treasuries to gold for real safety. No major crisis has hit yet. No bank collapses, no forced massive QE programs. But analysts warn that domestic debt problems and private equity stress will trigger it soon. New Federal Reserve Chair nominee Kevin Warsh wants lower interest rates to rebuild industry, plus smaller balance sheets simultaneously. History proves that's impossible without printing more money. Reserve shortages already forced QE-style buying in December 2025. When the domestic crisis arrives, new QE money stays trapped inside the United States while gold becomes the preferred global settlement asset. Russia's conditional exploration of dollar use under strict terms doesn't change this trajectory. It shows pragmatic flexibility, not retreat from de-dollarization. Unstoppable dollar weakness and the coming crises are setting gold up for its most explosive moves yet. Now let's talk about the bearish case because you need both sides to make intelligent decisions. Silver at 77 hasn't reclaimed 81 resistance. It could drop back towards 74 or lower if support breaks. Shanghai being closed for 8 days creates the manipulation window we're in right now. Banks still have tools to suppress paper price through concentrated shorts, derivatives, leverage, SLV arbitrage mechanisms. 6,000 contracts rolled from March to May shows delivery pressure can be postponed through contract management and cash settlement enforcement. 1,500 longs shaken out isn't massive capitulation, but it's still a reduction in delivery demand. March 26th, contracts could roll further to avoid physical settlement. COMEX has contained these situations repeatedly throughout decades of documented manipulation. J.P. Morgan paid $920 million in September 2020. Case number 1:019-CR-00438. They admitted guilt, then returned to the same desks executing the same trades. Paper manipulation persisted before and can persist again. This is financial warfare education, not investment advice. Capital preservation comes first. The ones who survive volatility are the ones positioned when the real move comes. But here's the counter-argument, and this is where it gets interesting. Shanghai premium is $9 and expanding. Physical metal in the East is commanding bigger premiums, while Western paper consolidates. SHFE closing with 11 million ounces versus 360 tons open interest means essentially full allocation with zero buffer. COMEX has 93 million registered versus 295 million March claims. Only 1,500 contracts shaken out despite a massive manipulation effort. Banks extracted only 2 million ounces from SLV during the entire shakeout. 22 exchange account suspensions in 1 week. Silver bounced exactly from 74, as the technical structure indicated. That's not coincidence. That's support holding where analysis suggested it would. When manipulation requires massive coordination, thin volume, everything sell-offs across asset classes just to extract 2 million ounces and shake out 1,500 contracts, that's not strength. That's desperation masked by volatility. Here's what matters right now. Silver is at 77. 150 EMA resistance is at 81 overhead. 74 is support underneath. Shanghai premium is $9 and expanding, not contracting. COMEX registered is 93 million and bleeding out on Friday the 13th. March, open interest is 295 million ounces versus that coverage. SHFE suspended 22 accounts in 1 week for manipulation. 6,000 rolled from March to May. Desperate shorts are buying time. Only 1,500 longs got shaken out. Banks extracted only 2 million SLV ounces. Shanghai closes today through the 23rd. Expect more manipulation. China is dumping treasuries and accumulating gold. Russia's conditional dollar exploration doesn't change the de-dollarization trend. Watch what happens during the Shanghai closure over the next 8 days. Watch if 74 support holds or breaks. Watch if 81 resistance gets reclaimed with volume. Watch March delivery intentions leading up to the 27th. Watch the Shanghai premium when markets reopen on the 24th. This isn't about prediction. This is about observation. Let the market prove itself. The ones who do that homework see manipulation failing to achieve its objectives despite maximum effort. They understand why a $9 premium matters when it keeps expanding. They recognize the pattern when technical support holds exactly where analysis indicated while fundamental pressure builds underneath paper suppression. Invest with logic, not hype. This is John, and I'm out.